Thank you all for being here, giving me this opportunity to speak at the first Objectivist conference I've attended. And thanks to the Ayn Rand Institute, of course, for sponsoring the conference and my talk. The topic is a rather ambitious one. I could give a long lecture about free banking. I could give a long lecture about the Fed. I'm here to give you a not terribly long lecture about both. Well, I want to start. Oh, how do we get our slide to take my place up there? Well, that's progress. There we go. I want to start by, first of all, giving you a warning. And the warning is that when I talk about free banking, you mustn't have an image like the one on the screen in your mind. You mustn't, in other words, be thinking about certain claims that have been made about free banking experiments in the United States. There were such things as free banking laws in the United States before the Civil War, quite a few of them. But like many laws, the names weren't accurate or descriptive. In fact, the kind of banking system I have in mind when I talk about free banking is quite a different arrangement. I'll get around to telling you exactly what happened in the United States and why the arrangements that existed there really shouldn't be called free banking or shouldn't be regarded as free banking arrangements. But before I do that, I want to talk about a real free banking arrangement, or one of the ones that comes closest to the ideal I have in mind. And for that, we have to look at Adam Smith's Scotland. In Scotland, in the years roughly from the time Adam Smith was writing The Wealth of Nations until just before the middle of the 18th century, you had a banking system that was noteworthy for the fact that it was relatively unregulated. And by free banking, in the sense in which I wish to employ the term, I simply mean banking that's free from severe government regulations, or regulations other than the normal ones we associate with the protection of contract, enforcement of contracts as written, and so on, the prevention of fraud. In the Scottish free banking system, there were some other government regulations that were not just the sort of thing we would want to see in any free enterprise system. There was, first of all, restriction of entry into the banking system, but it wasn't very severe. At some point, there were several dozen banks issuing their own banknotes. You see some specimens of such here. There was also, sometime after a crisis which occurred in 1765, there was a ban placed on small notes, notes of under £1, one British pound, which was a significant sum of money back then. But those were, in essence, the only departures from something very close to a laissez-faire banking system. And the most important fact about this arrangement, the thing that distinguishes it most from modern currency systems, is the fact that currency, paper currency, was supplied competitively, not by a monopolistic bank or central bank, as is almost everywhere the case today. Now, in the days of the Scottish system, of course, the banknotes that were being issued were redeemable claims, or IOUs. They weren't considered money in the strict sense of the term. They were substitutes for money. The real money in the Scottish system consisted of specie, of gold or perhaps silver, depending on what era we're talking about. And banknotes were claims that were readily redeemable in gold or silver. Now, it's true that the notes of the Scottish banks were so trusted, people had such confidence in them, that they actually preferred these paper notes to gold or silver coins and used them wherever they could. In fact, it was a common quip in Scotland that the first thing a Scottish person did if he got hold of a gold guinea was to bring it quick to a Scottish bank and get rid of it in favor of some nice Scottish banknote paper. That tells you already something about the confidence people had in the Scottish system. Now, I should tell you, in case you were wondering, that this confidence existed throughout the history of the system, despite the fact that if you actually looked into the gold reserve ratios of the Scottish banks at any time in the period we're talking about, but let's say around 1820 to pick a specific date, you would have found that the gold consisted of only something like 1% of the total outstanding IOUs, demand IOUs, particularly banknotes, which were the most important IOUs at the time, circulating IOUs. So the gold reserve ratios were very slim, but don't be misled by that fact. They were slim because of the confidence in the system and its good reputation. They weren't slim in a way that endangered the reputation of the Scottish system. The low reserve ratios were a result of the growth of this system through its successful maintenance of its promises to pay. Now, one of the keys to the Scottish system and to any competitive currency system, any free banking system, is that the system is regulated. It's not unregulated. It is regulated by market forces. It's regulated in the way that other competitive industries are regulated. But in this case, the regulation that competition provides takes a very specific form. That form consists of the daily reckonings the banks are confronted with, wherein at the end of each day, every bank has accumulated notes from other banks, and those items are returned to their sources for payment. To a very large extent, the items being presented by the different banks back to their rivals will cancel each other out. However, there will always be some residue, a residue the exact quantity of which can never be predicted in advance, that's going to have to be settled, in the Scottish case, mainly with exchequer bills, which were government bonds, but with the small change of the settlement being made in actual gold or silver. This daily settlement among these competing issuers of banknotes was a crucial source of discipline in the system. It meant that no Scottish bank could be overgenerous with its lending, or it would come up short at the end of the day after the clearing and settlement process was over, and it would find itself losing reserves to its less generous rivals. You might say that the regulatory principle involved here is not so different from what's involved in a chain gang. You see from the picture, in case you're not familiar with the notion, what a chain gang is. It's a bunch of prisoners who aren't locked to any unmoving surface or structure. Rather, they're chained to each other. Now, how does this keep them from escaping? It keeps them from escaping because it's impossible for the prisoners to coordinate their movements so as to escape. If one prisoner moves ahead, tries to run away, he's tripped up by the fact that the others don't move at the same time. And so it was in the Scottish free banking system and in other free banking systems. If one bank overissued, it was tripped up, so to speak, by the fact that it lost reserves to its rivals. And this meant that no bank could be overgenerous with its issues of currency. And it was very hard for a system even of a dozen banks, let alone several dozen, to coordinate to overcome this automatic regulatory mechanism. So in practice, the banks could never overissue, either individually or collectively. That didn't mean that the amount of currency that they could collectively issue didn't vary over time, but it would vary with the demands of the public, and I can explain that more precisely by saying that when the public wanted to keep larger balances of currency, those extra balances would mean that a smaller proportion of the currency made available to the public through lending would find its way back into the clearing and settlement system. So the banks could get away with more expansive lending when the demand for money balances increased. And this is something that macroeconomists today would say is a not bad way for a banking system to behave. This figure, which is as technical as I will get, I promise, pretty much sums up the way things work. I don't have a pointer, so you'll have to bear with me as I go ahead and explain the axes. The lower axis shows total reserves, and this would be reserves. You could reckon them in terms of gold or silver, or the exchequer bills the banks have on hand, which we would today call their secondary reserves. Anyway, that's what's on the lower axis, and these would be denominated in pounds, right? British pounds. By the way, the Scottish banknotes were all British pound units, so they'd be £1 note, £5 note, so on. On the vertical axis, you have the total flow of expenditures and or payments, and I reduced that to the terms M and V. And this is now, I'm feeling like I'm sounding a little bit too much like an economist, but M is the stock of money. V is its velocity of circulation, or how rapidly it turns over in payments. All right, now I can explain what the schedules on the chart refer to. The vertical schedule is simply a given stock of reserves available to the banks. I assume that there's just a certain amount available at any time. So that's the supply of reserves, and that's fixed. The upward sloping schedule shows the demand for reserves, and that's a function of total payments that are flowing through the clearing system. And the reason for that is that the more Scottish banknotes are, the greater the quantity flowing through the system, the greater will be the need for reserves for the settlements of uncertain balances due at the end of the day. And as you can see, that schedule is an upward sloping function of total payments. If no one spends any money, there can't be any need for settlement reserves. So the demand is zero. That's the lower left-hand corner. As spending goes up, so does demand, but not quite proportionately because of economies of scale. At some point, demand and supply are in equilibrium. That equilibrium represents a certain level of spending in the whole Scottish economy. Okay, so that's simple, but here's what's neat. If people spend more because their demand to hold money goes down, that will drive reserve demand up, but that would create an excess. Banks will have to adjust by reducing their lending and reducing the supply of money that's available in the economy, bringing total spending back down to that level such as will cause the demand for reserves again to equal the supply. The opposite happens if people stop spending as much. So the Scottish system had a wonderful quality of automatically tending to stabilize the overall level of spending in the Scottish economy. I mention this because today there are macroeconomists who are going around saying what we need is a central bank that keeps the total level of spending stable. Well, yes, we could use such a bank, but the problem, of course, is that central banks aren't any good at stabilizing spending. And this is why we have bouts of inflation and over-speculation, and also sometimes deflation and depression. Usually one followed by the other. And again, what happens when you create a central bank like the Bank of England? Well, the conventional wisdom says that central banks are stabilizing institutions. They create macroeconomic stability because, don't you know, if we don't regulate money, we'll have instability. The actual historical and theoretical truth is precisely the opposite. Central banks are highly destabilizing. And it's not, this somehow hasn't quite translated into, let's see if we can adjust that. I don't think we can. Well, I'll just summarize this slide. Apparently it has to do with the font. The fact is that central banks are highly destabilizing because their monopoly privileges. A central bank is, after all, nothing but a bank given the privilege, the unique privilege of issuing paper money, and thus a substitute for a competitive currency arrangement. These privileges cause it to escape the discipline of clearings that is the key source of market-based regulation in currency, and indeed allow the central bank, the privileged bank, to be a source of booms and busts. Now, it shouldn't surprise us, really, if we take a historical perspective, the central bank should be destabilizing, because the earliest central banks were set up without any thought of stabilization. No one gave any thought to that. The purpose of early central banks, including the Bank of England, was entirely fiscal. The Bank of England was set up to generate money to help King William III wage war with France. It would have been an absolute coincidence if this institution, given its privileges for entirely fiscal reasons, should have turned out to have been a good thing for the stabilization of the English or British money supply. It was no such thing. The Bank of England Act, by the way, was a part of a tonnage act, explicitly designed to raise revenue and with no other purpose. How does a bank monopoly disrupt the natural self-regulatory mechanism? A central bank isn't like a member of a chain gang, like one of a system of competing banks. It's more like a Pied Piper of credit. When it expands, the other banks follow along, because its expansion provides the wherewithal whereby they can create more credit as well. Why does this happen? Let's go back a couple slides. In a free banking system, banks hold their own reserves of specie, gold or silver, and perhaps as secondary reserves, treasury notes. But create a central bank like the Bank of England, privileged to, given the unique privilege of issuing paper currency, and what happens? Since the other banks are restricted in their ability to issue their own paper, they treat the paper of the central bank as approximate reserve to hand out to their customers, since they have nothing of their own to hand out. Just as banks today use as reserves Federal Reserve notes here in the United States and put that stuff in their cash machines. Believe me, if banks thought they could get away with it, they'd love to stuff their cash machines with their own IOUs and thus profit from the float involved. So that vertical line for reserves in a central banking system isn't just the supply of gold. It becomes the supply of central bank credit. And if the central bank is generous, that vertical line moves out. If the central bank gets stricter, it moves in. It's no longer the gold or silver stock that determines the total availability of credit or the maximum amount of spending in the economy. It's how generous or tight the central bank is in its lending policy. That's what I mean by a Pied Piper. So now one bank has the capacity, by its own errors of judgment, to disrupt the equilibrium of the whole system, to cause spending booms and spending busts, with corresponding effects on the real economy. Now, in those days when the Bank of England was first established, and for the first 100 and 200 years of its existence, there still was a limit on how much inflation it could get away with. That limit was explained very well by the Scottish philosopher David Hume, who talked about what he called the price specie, or what has since been called the price specie flow mechanism. It's very simple. In those days, it wasn't just England that was on a gold or specie standard. Specie just means either gold or silver. It was other countries as well. Well, that meant that if English prices went up too much, people would stop buying goods in England and start buying them in France, and that would mean that gold would have to flow from England to France as the balance of payments became adverse for England, more adverse. This chart shows an example. As long as the price level in terms of some fixed quantity of gold, as long as prices in England don't vary much from prices in France for tradable goods, here you see the case where the French price level is assumed to be unchanging, then there's no problem. You have an international equilibrium. But imagine that the Bank of England expands overly generously, thus expanding the reserve base for the rest of the English banks, who will only follow along as they would if they were rats or children being led by the Pied Piper. Then the British or English price level will at some point exceed the French price level by an amount making it worthwhile for people to buy more of these tradable goods in France. Well, you can't shop in France with Bank of England notes. That means that you have an external drain of gold from the Bank of England. And that eventually causes the bank to retrench, to tighten, to make up for its excess loosening in the past. And you must remember that the bank had no idea when it was violating the terms of international equilibrium. Why, there was no such thing as a measurement of the British price level back then. And even if there had been, it would probably be imperfect, as today's measurements still are. So the bank could hardly help violating international monetary equilibrium and causing bouts of boom followed by bust. And when the bank would retrench to save itself, it just, in other words, would make up for its previous overexpansion, it would cause a crisis. How many of you have heard of Walter Bagehot? A few. How many of you read The Economist? You'd recognize the name perhaps from the column Bagehot, still appearing in that magazine. Bagehot was The Economist's second editor, but he was also a man of many accomplishments, one of which was the writing of a very important book on the British money market called Lombard Street. Now, in Lombard Street, published in 1873, Bagehot famously offered advice as to how the Bank of England should behave so as to minimize the severity of British financial crises. He noting that in some past crises, the bank directors had acted only to save the bank, even though that meant plunging the rest of the British economy into depression. He argued that the bank had a public responsibility, in light of its monopoly privileges, to act in a way that would not cause the rest of the economy to suffer. And his advice based on that premise was that when faced with an external drain of specie, the bank should continue to lend freely to solvent but illiquid firms, though charging a high rate of interest. The free lending would prevent other firms that were solvent from failing due to excessive credit restriction, while the high interest rates would help attract capital from abroad and thus counter to some extent the external drain. This doctrine has since come to be known as the classical lender of last resort doctrine. All central bankers will tell you that their job is to act as classical lenders of last resort. Ben Bernanke on numerous occasions said that he believed the Fed was both obliged to act according to Bagehot's advice in Lombard Street, and that it did in fact act that way. In fact, the latter statement is not true, but I don't have time to go into it in any detail. What Bernanke and other central bankers don't tell you is that when Bagehot made this suggestion, he said quite explicitly, and in several places in his book, that this was a second best solution, that he was making recommendations, a recommendation concerning how this bank monopoly should have behaved so as to do as little damage as possible. But he explicitly says that England would have been better off had it never established a bank or currency monopoly, had it maintained or established a Scottish-type free banking system. And here you see the quote. I won't read the whole thing to you, but it's quite explicit. A natural system of banks where each bank keeps its own reserves and none has a monopoly. That sort of system wouldn't face the problems the English system faces in the first place, and so wouldn't need a lender of last resort. You need a lender of last resort when you have a bank monopoly that is capable of not lending enough and other times lending too much. I'm sometimes reminded when I hear central bankers say, Bagehot said we should all have, every country needs a central bank to act as a lender of last resort. It's as if your neighbor had trained a lion to go get the morning newspaper. And you decided that you need to have a lion too, or how are you going to get the newspaper? Here's the rest of Bagehot's quote. I propose to retain this system, he said, that is the Bank of England system, because I'm quite sure it is of no manner of use proposing to alter it. You might as well, or better, try to alter the English monarchy and substitute a republic as alter the present constitution of the English money market, founded on the Bank of England. Already in 1873, that monopoly was so entrenched that it was felt by Bagehot and many others that, well, we're stuck with it. But that, of course, was no reason to impose similar central banking structures on other countries. It was no reason, for example, for the United States to adopt a central bank. By the way, it's ironic that today I would say the monarchy is on much less firm ground than the Bank of England and central banking, though I hope that with John Allison's help at Cato, we're going to change that. I would like people to think about central banks sort of the way this picture suggests they think of monarchies one day. Anyway, let's talk about the Fed and what happened in the United States. Now, some of you, no doubt, are aware that we had financial crises in the United States before the Federal Reserve System was established in 1913. So you may be thinking, Selgin says crises are caused by central banks, so that can't be right. We had crises without a central bank. Well, now, be careful. Selgin didn't say that only central banks can cause crises. What I did say was that an unregulated free banking system will not have crises. There are other ways you can cause crises with regulations short of establishing a central bank, and that's what we did in the United States. Now it's time to talk about these banks. Well, first of all, in the early days of the Republic, even at the very beginning, we never had unregulated banking. We always heavily regulated our banks in some fashion. In particular, early on, we very, very strictly limited entry. Here's the situation in 1835. It's as if the distribution of banks is as if you took a salt shaker and shook it on Massachusetts and let the little grains spill out from there. So there's 105 banks in Massachusetts, seems pretty good, and then the numbers tend to decrease as you go south and especially west, with some territories and states making banking altogether illegal. By the way, they ended up with the very worst junk from the rest of the country or from counterfeiters who took advantage of their prohibitions to supply what the public needed, but in the very worst possible forms. But even in Massachusetts, with 105 banks, there wasn't a very good, well-developed banking system because, like most states, Massachusetts did not allow any bank to have branches. And the lack of branching meant that at most there were 105 towns serviced by banks in Massachusetts at this time. Probably 70 of those banks, though, were in Boston, so there were really only about 35 towns that had banks at most. The lack of branching was itself one of the most deleterious regulations in U.S. banking and would remain a deleterious regulation until the 1990s, incredibly. Oh, the Scottish banking system was completely branched. There was no limitation on branch banking. In 1836, starting in 1836, some governments state governments began passing free banking laws, so-called, and this is where a lot more confusion comes in. These laws were called free banking laws, but that name only referred to one aspect of freedom, and a limited one at that. Under the free banking laws, it was no longer necessary for a bank to secure a charter by means of a vote of the legislature for that particular bank. That's how it used to be. Now there was something approaching or resembling a general incorporation procedure. So far, so good, though studies have shown there wasn't even that much of an improvement in entry because of the other provisions of the free banking laws that could be very onerous. Let me tell you something about those provisions. First, none of the states with free banking laws, and there were a dozen eventually, allowed any branching. So that didn't change. Indeed, under the branching restrictions were particularly severe in the so-called free banking states. Also, and significantly, all the banks established under free banking laws had to back their notes with specific securities as indicated by the state regulatory authorities. And guess what? Many of those state authorities told the banks that they had to back their notes with the bonds of that state government. Here we see the fiscal motive, so important in banking. Do you know what the main cause of failures of these free banks was? It was the depreciation of the bond collateral that they were required by law to hold because they weren't free to choose their own. That was the main cause. So regulation was the main cause of failures, and some of the free banking systems had notorious numbers of failures, but it was regulation that was behind it. Well, all this changed because of the Civil War. The Civil War presented a vast fiscal challenge to both of the governments involved in the conflict, but here we're mainly concerned with the Union government, which sought to finance the fiscal war by toying with the monetary system, and it did that in part by establishing a new system of banks called national banks. These banks would be established under a new national law that resembled some of those old state free banking laws in that banks did not have to have a special vote to be established to get federal charters in this case. They could get them by just abiding by certain regulations, one of which was, guess what? That they could only issue notes backed by certain bonds. Guess which bonds? The Union government's bonds, because the idea is not to create a good banking system or currency system, it's to pay for a war. And when you set up a banking system to pay for a war, as England did in 1694, you often end up with a system that isn't much good for anything else, even if it did succeed in helping to pay for the war. And that's what happens in this case. Because the demand for national bank charters proved disappointing at first, they imposed a 10% tax on all state banks, good or indifferent, and put state banks out of the currency business. So from now on, currency is issued only by national banks and also by the Treasury, which has been issuing greenbacks during the war. U.S. legal tender notes. I won't say much about them. I will say that the new currency system based on the new national banks proved to be very unstable. It gave rise to periodic, severe crises, a crisis in 1873, a crisis in 1884, an even worse crisis in 1893, the worst of all in 1907. Brief discussions of the origins of the Fed will simply say, we had lots of crises, so we established the Fed. Bernanke sums it up that way. What he doesn't tell you, though, is those crises had a regulatory basis. And I don't just mean regulations were part of a complicated story that led to the crises. I mean the regulations caused the crises. Specifically, those bond collateral requirements of the Civil War tied the supply of national bank currency to the outstanding federal debt. Now, if anything were to happen, imagine this, that would have resulted in the retirement of all the federal debt, the total amount of national bank currency that the banks could have supplied to the public would have been zero. Now, of course, they didn't end up ever retiring the federal debt. However, after the Civil War, they reduced it considerably. The federal indebtedness fell as we ran surpluses, government surpluses, throughout much of the last part of the 19th century. Now, the result of this declining stock of federal debt, and particularly of securities that were eligible for backing national banknotes, had the perverse effect of causing the supply of national currency, national notes, to decline. By 1890, it's less than half what it was in 1880, and this during a period of rapid economic growth. There's some improvement after the 1890s due to a relaxation of the bond eligibility requirements and introducing new bonds that were eligible, but it still doesn't allow for much growth. The other problem is that there's no potential for seasonal or cyclical variation in the supply of currency to match changes in seasonal or cyclical demand for currency. None at all. It's simply not worth it for a national bank to go out looking for these increasingly scarce and expensive bonds and buy them even at heavy premiums, you can see the prices of the bonds on the left, they're commanding quite a premium by the 1890s, just for the sake of putting out notes temporarily, which will then come back and sit in the bank's vaults. That would mean taking a huge loss. So the banks only put out what they think will stay out. And that means that every autumn, when there's a peak demand for currency, as there was back then to bring in the crops, there would be a stringency in the currency market, a tightening of credit, high interest rates. Now, for reasons I can't go into, this stringency would end up being felt most, not in the countryside where the crops were actually being moved, but in New York City. And this has to do with other national banking regulations that allowed banks in the country to count as reserves claims against banks in Midwestern cities, and allowed those banks to count as reserves claims against New York banks. So that when there was tightness in the countryside, suddenly everyone would be trying to get the same money out of New York, where $1 of gold was supporting $3 of reserves. That's the reason for the crisis. Now, again, Ben Bernanke and other central bankers, apologists for the Fed, will say we needed the Fed to prevent this sort of thing, to give us an elastic currency, a currency that would grow as the country grew, and a currency that would be seasonally flexible so that we could move the crops without having credit crunches. Oh, there's another chart, another plot. It's a different scale. That's the plot in a different version of this talk. I don't have it written down what that is. And I say, well, it must be a good central bank-based currency system because, look, the supply of currency is doing just what you would think it would do if it was adhering to changes in demand, right? Except this is the Canadian stock of Canadian banknotes, and guess what? At this time in history, Canada doesn't have a central bank. Canada has a system very closely resembling the Scottish free banking system. Not by coincidence, by the way, because it was run by Scotch or Scottish Canadians who started these banks, looking over their shoulders at their ancestors' banks in Great Britain. The Canadian system shows exactly what happens when you have market regulation of currency. It does just what an ideal central banker would do, but not what any actual central bankers ever do. Here are some Canadian banknotes. There were several dozen Canadian banks of issue at one time, though again, entry was restricted, unfortunately, and that led to consolidation over the years. This was not a desirable thing, but it was an undesirable feature of the Canadian system that was a reflection of one of the few ways in which it departed from true freedom of banking. People knew in those days. They were perfectly aware of the superiority of the free Canadian system. It was notorious. And reformers, before they turned to the central banking option, made attempt after attempt after attempt to set up, to reform the U.S. currency system along Canadian or, as it were, Scottish lines. It's interesting that one of the previous speakers, I'm sorry, his name is escaping me, it's Andrew... Lewis, yes, Lewis, spoke about William Jennings Bryan in connection with some other bad developments in this period. But what you may not know is that it was largely thanks to Bryan's influence, but also due to the lobbying of special interests in Wall Street and Main Street, that these proposals to deregulate the currency system of the United States and make it more like the Canadian system all failed. Bryan, of course, was a populist who, having championed free silver, felt that the next best alternative was to have paper money issued by the government, more greenbacks, in other words. He thought that a private bank currency was the worst possible option, and he derailed all of the proposals to deregulate the national banks and state banks because of that belief. Ultimately, though, he threw his support behind the Fed as a compromise, owing to his status as Secretary of State under the Wilson administration. Of course, the result of the failure of these previous attempts is that we do turn towards central banking again. as a second best or third best or maybe, who knows, fifth, sixth, or seventh best solution to our currency problems. It was not the only solution, and it was certainly not the best solution. In fact, it was a very bad solution because it didn't work. Instead of eliminating crises, as it was supposed to do, as it promised to do, the Federal Reserve System caused a far worse crisis, indeed several far worse crises than those that had occurred under the preceding national banking system, which is an acknowledged bad system. Right? I'm not an apologist for what came before the Fed. I agree with all those who condemn it as a bad arrangement. I merely wish to observe that the Fed is also a bad arrangement, and by many criteria, it's been a far worse arrangement. That's the subject of another talk, but for now, I'll just assert it. Here you see the consequences of the Fed's failure to perform the very purpose it was set up to perform. In the massive failures of banks in the 1930s, the numbers were great in the 20s as well. The number of banks, though, really starts to take a nosedive at the beginning of the Depression. The money supply follows the collapse of the banking system, and that translates into a terrible decline in prices, but also output of goods and services. We're back to the instability that was a notorious problem of the British system. The one thing that we have in common in both of these stories of financial crises is the presence of a monopoly bank of issue. Now, Canada still doesn't have a central bank at the beginning of the Great Depression, so it's worth observing what happened to its banking system. The number of banks that failed in Canada was, well, 0. Not a single bank failed in the 1930s in Canada. The last bank failure in Canada, and it was a rather unusual and notorious case, was a failure in 1923. And that was already a blotch on the Canadian system's record. But it's nothing as compared to the performance, both before and after the Fed, of the American banking system. By the way, the Fed contributed nothing to recovery from the Depression. Having allowed the collapse of money to take place, this chart tells you what the Fed contributed to reviving spending, rebuilding the money supply. Nothing. The recovery that takes place is due to expansion of the gold stock. You can see a big increase in the gold stock between 33 and 34. Alas, that is simply due to the revaluation of gold after Roosevelt confiscated it all and then devalued the dollar. But after that, you have an ongoing increase in the gold stock, and that's mainly because of Hitler and the consequent flow of gold from Europe to the United States. Federal Reserve credit, remarkably flat. So here we have a good example of a central bank that's supposed to make up for its own mistakes, in this case the speculative boom the Fed caused in the 20s and the consequent external outflow of gold towards the end of that period, is supposed to make up for that mistake by acting as a lender of last resort once the crisis hits. That's Bagehot's second best advice. Here you can see what's happening to Federal Reserve credit. This is a lender of last resort that doesn't lend when it's a last resort, but lends when it shouldn't have lent at all. The Fed has not even improved upon the national banking system that preceded it in stabilizing the economy and avoiding recessions. And we have the testimony of an economist who cannot be described as an objectivist or free banker or laissez-faire proponent, Christina Romer, who was Obama's first head of the Council of Economic Advisors. In 1999, she wrote, "Recessions have not become noticeably shorter over time since the Fed. The average length of recessions is actually a month longer in the post-World War II era than in the pre-World War I era." So she's leaving out the Great Depression in this comparison. She's leaving out the Fed's first 20 years because everyone admits those were absolutely disastrous. Even if you just look at the post-World War II Fed record, right, this is the conclusion. There's also no obvious change in the distribution of the length of recessions between pre-war and post-war eras. Now, that seems to me a rather miserable report card for an institution that was established for the purpose of avoiding recessions and crises. And that's the report card in 1999. Do you think the Fed's grades have gotten any better since then? I think it went from a D- to an F. Well, we're not going to talk about the housing crisis, except that I will say it's just another example of the kind of crisis that goes back to the days of Hume and the days of Bagehot. It's the same old story of a central bank making credit overly abundant in good times and then having to face a financial crisis in bad times that it deals with very poorly. And I would submit to you, though it has to be a subject perhaps for the question and answer session, that both the Fed's actions prior to the recent subprime crisis and its response to that crisis were among the reasons why we had such a terrible recession and such a long-lasting one. But I'm going to stop with that assertion and leave us more time for questions. Thank you very much.
Hi.
Yes.
Could you elaborate on the importance of branches, allowing branches in banking? I didn't understand that.
Yes, that's a very good question. I feel as though I ought to let John Allison come up here and answer that question, since he's one of the great branch bankers of American history. But I'll give you an academic response. And that response is simply this, that as students learn in basic finance courses, the first principle of finance is that of financial diversification. All of us know in our private conduct that when managing our savings and especially our retirement accounts, we want to diversify assets because you can have trouble in some of your investments, but if the other ones are doing well, then these fluctuations can cancel out. Banks that couldn't branch, especially banks that couldn't branch way back when, were very limited in how much they could diversify both their asset and their liability portfolios. Remember, loans couldn't be marketed or bought and sold in the 19th century, so lending was strictly a local phenomenon. If the local industries were limited, especially if they were limited to one crop, for example, then all the bank's loans are tied up with this one crop. A crop failure is enough to ruin the bank and cause losses to be borne by its creditors. So lack of ability to diversify by being able to lend in different geographical areas was a very potent source of bank failures. Now, of course, if banks had had plenty of capital, that would have helped protect them against the shocks to which lack of branching would expose them. But guess what? A bank that can't branch can't raise much capital. It is not an attractive proposition for capitalists. So you have you're stuck between a rock and a hard place. This is on the asset side. Very quickly on the liability side, it's often a good idea to diversify a bank's liabilities because, well, a rumor could start in some area and the depositors or note holders stage a run. It doesn't happen that often, as you might think, but it can happen. But a branched bank is hardly likely to suffer so much because the rumors are going to be isolated to certain branches. The other branches come to the rescue by shipping the reserves to where they're needed, and that's the end of that. The panicking depositors are put at ease and the runs stop. But with unit banking, forget it. Any bad rumor, again, like a bad harvest, could be the death knell of the bank in question.
Hi, thank you for your talk. One thing that I didn't see in the presentation was the first bank that got America started, Alexander Hamilton's National Bank, which was privately run, gold-backed, gold and silver-backed, and had a 20-year charter. And it was a national bank, but my opinion, the common misconception is that his national bank led to the central bank, which led to the Federal Reserve. I'd like your take on that.
Yes, your question is a very welcome one, because I did not talk about the first two federal banks, the Hamilton's first bank of the United States, and then its successor, the second bank, which their charters did run out after the initial, after being renewed once in each case. So they ran for relatively short periods, and then after 1836, we don't have any federal government involvement. So, were these banks a good thing? Yes and no. This is a complicated case because, on the one hand, you have the federal government establishing banks. I don't think that's a bad thing. It was a very good thing in one respect, because the federal banks were not prohibited from branching. So they uniquely could have branches throughout the country, and they did. Alas, and here is the negative part of the ledger, each one was a monopoly. The federal government never entertained the possibility of allowing competition, that is, a competitive entry system based on federal charters, while also encouraging branching. So, why is that bad? Well, a bank that can branch that's a monopoly is better than a bank that can't branch that's a monopoly. But these banks, being monopolists, could behave very badly in the same way that modern central banks can behave badly. They might be tempted to lend overly generously, relying on other banks reissuing their notes, playing, as it were, live and let live. The history of the second bank in the United States is very illustrative of these dangers. We don't know so much about the first, because the records were destroyed in the War of 1812. But in the case of the second bank, it's like it makes for quite a good soap opera, with intervals, depending on who was in charge and what the politics were at the time, intervals during which the bank was being very loose in its credit and playing live and let live with the state banks, partly to buy the support of state of senators and congressmen in the various states for renewal of the charter, right, politics, and other times being very strict with credit, even to the point of generating crises, perhaps on purpose, as Biddle is accused of having done in a desperate bid to save the bank from Jackson's attempt, ultimately successful attempt to defeat its renewal. So they're very dangerous. Was Hamilton's bank, all things considered, a good institution? Hard to say. But it was certainly a very dangerous institution, as we know from the conduct of its successor, and far from an ideal setup.
Okay.
You have a follow-up?
Yes, I do, actually. Hamilton was dead by the time the second bank was chartered, and it was effectively to run the War of 1812 from James Madison and Thomas Jefferson. That was the main reason for the second national bank.
No.
So
no, the second is established in 1816. After the War of 1812. There's no federal bank between 1812 and 1816.
Okay, all right, thank you.
Thank you. So what we've seen since the crisis is the Fed rapidly expanding its balance sheet and reserves on the balance sheets of the banking system. But one thing we haven't seen is we have not seen an expansion of the lending book, which everyone who understands fractional reserve banking is afraid will cause price inflation when it takes off.
You're talking about the private commercial bank lending.
Yes, I'm talking about the relationship. I'm talking about the fact that the commercial banking system has such vast deposits with the Feds, $2.5 trillion or something, but they're really not lending it, they're not multiplying it, they're not doing what a lot of people would have expected them to do at this point, and therefore we don't seem to have we have very low CPI type inflation, even though you can argue there's plenty of inflation elsewhere. So my question is, it's occurred to me that the Fed, at being not only the originator of the monetary base, but also the main bank regulator, can very possibly control the amount of lending that happens in the commercial banking system.
Indeed.
And if they can do that, they can control the price. I'll just take it as a given that they'll cause economic stagnation, and I think that's maybe happening. And maybe you could comment on that if you think that's true. But my real question is do you think that by doing that, the Fed can impose stagnation but prevent a crisis, because they will really impede the rate at which currency and credit will be expanded?
Well, I think you can at most give the Fed credit for being able to forestall a crisis of one type by causing a crisis of a different type, and that's what it's doing. So the reason it is indeed the case that the massive expansion of the monetary base, and bank reserves are part of that, has not translated, as many thought it might, into a corresponding expansion of commercial bank lending and to a corresponding expansion of total spending and ultimately of an increase in prices, because of an exceptionally enhanced post-crisis demand for liquidity, not just on the part of banks, but on the part of many kinds of business firms. And the Fed is responsible in part, I won't say entirely, because depression itself, of course, causes a collapse in the demand for credit, but the Fed has aggravated this through its own policies. First of all, it started perversely in October 2008 to pay interest on bank reserves at precisely the time when it was most desirable that those reserves should be employed instead of held. And I've never heard a good answer to why the Fed did this. The Fed apologists, economists, will say, well, we were afraid that if we reached the zero lower bound of interest rates that there would be a cessation of lending. And so we paid interest on reserves so we wouldn't reach zero. But of course that just means that lending stops above zero. It's like saying, oh, we've had people jumping off the Empire State Building. Everything's fine till they hit the ground and then, well, splat. But I know what we can do. We can solve that problem by just building a big porch that sticks out around the second floor. And then they'll never hit the ground. See? That's as good as I can do to explain that logic. But the other way in which the Fed and other regulators have contributed to this creation of this massive reserve sump is through regulation. And again, John can tell you more about this, John Allison, than I can. But regulation is highly pro-cyclical. What I mean by that isn't that the regulations change on the books with becoming more stringent in that sense when there's a recession and more loose when there's a boom. What I mean is that the conduct of the regulators and the way in which they enforce existing statutes is pro-cyclical. They turn a blind eye to all kinds of things when everything's hunky-dory, and then they slam down tight after the crunch has already occurred. And so they make things worse. It's much harder for banks to lend now than it was during the subprime boom when it was all too easy. And Fed regulators, as well as other bank regulators, Federal Reserve regulators, are doing their part or have been doing their part to realize this result. So I think I agree with the statement on the whole.
Do you think that will thereby delay, do you think that will thereby delay a significant crisis because you will not get a huge credit expansion?
Yeah, the good news is we won't have any inflation because the Fed is making sure we don't have a real recovery. The bad news is if it allows us to have a real recovery, we might have some serious inflation. And even the Fed's official exit strategies reflect this rock and a hard place it's put us all in. Because, among other things, the Fed has said, because there's a real danger they cannot mop up the excess reserves once they really become excessive, that is, once banks start putting them to use, the Fed has said, well, we can raise interest rate on reserves. Yes, but what does that mean? It means that we're going to make sure that lending doesn't really recover much, or at all, to prevent inflation. In the end, we end up with an economy where there's no private bank intermediation at all. All of our savings are essentially, our currency savings or monetary savings are all being intermediated through the Fed, which is seeing to it that nothing is done with them, nothing productive. Not inflationary, but it's not productive either. There's no credit, there's nothing. So we'll live in a non-inflationary economy where there's no growth. And that's where we're headed. Or to an inflationary economy where we might manage some growth, but of course inflation always means that the growth is accompanied by distortions and losses of all kinds. So the situation, I think, is very dire. It was a mistake, though, for many market-oriented economists to have assumed early on and made bold predictions about how high inflation was going to get. They underestimated the authorities' ability to substitute one problem for another. They didn't overestimate the overall worth of the Fed. They got it right in the sense of predicting that the Fed was going to foul up, but they didn't allow for the fact that the Fed has many ways of fouling up.
First, thank you for your great talk. This is
You're welcome.
been great. Can you describe at a high level what you think is the best plan for abolishing the Fed and replacing it by a free banking system?
I'm going to give you a cop-out philosophical answer to that, but in fact it allows me to do a dry run on a talk I plan to give at a Cato outing in September. I think the best plan is a plan that begins by trying to change people's understanding, which is what I'm trying to do today. Look, I'm wasting my time if I talk as if we could have a lecture like this where some congressmen or senators are going to say, wow, I never knew about all that. Well, let's just get rid of the Fed. I believe, perhaps because I'm an academic and I give the academics too much credit, and believe me, I'm not inclined to exaggerate the importance of academics, but I think the fact is that you don't get radical reforms through Congress. What you have to do is unradicalize them, which means changing people's understanding so that what was a radical idea is now the new conventional wisdom or conventional understanding. We have to therefore work on the opinion makers and work on the professors and work on the students so that instead of getting an eye roll from these people when you talk about getting rid of the Fed, you get a look that suggests that they get it, that they don't think it's crazy, that it is not an idea unworthy of respect. That's where you start. And if you can just change people's understanding, if you get enough people on board with that new understanding based on the history and the theory, if you get enough academics thinking that way and working on it, pretty soon you get to a state, it could take a long time, where instead of a congressman or senator being embarrassed to suggest the idea of getting rid of the Fed, they're embarrassed to apologize for the Fed. That's where we need to go. Then we can talk about what steps to take to get rid of the thing. But now there's no point. That's my cop-out answer.
I was wondering if you could briefly sketch as to what free banking might look like for the average consumer in a modern context. Like, would we have a wallet filled with like Wells Fargo, BB&T notes? How would prices work at the supermarket? Would everything be denominated in gold?
Yeah.
What would happen if they fluctuated?
That's an excellent question. So going back to the Scottish and Canadian cases, remember we had an outside reserve medium, gold, sometimes silver, that was an independent commodity medium that couldn't be manipulated by any authority. That's all history. Banks are in the business of issuing IOUs that are claims to whatever real money has been established in society. Banks aren't in the business of saying, oh, why don't you use gold or silver or something other than what you're using. They'll just give you IOUs in exchange for the money you bring them. That's the money that's already in use. What does that mean? It means that free banking, if were it introduced today, and it could be introduced today, would be free banking based on the established paper dollar standard, which alone, of course, wouldn't reform that standard money. The banks would simply issue notes, Wachovia notes. Is there still a Wachovia? I lose track. Wells Fargo notes, BB&T notes. We know those are going to be around for a long time. That are claims to Federal Reserve dollars. Free banking as such today would not be an alternative to central banking. So if you introduced it, and this is to some extent part of a real answer to the previous question, you'd still be left with the problem of the control of the supply of base dollars, reserve dollars, Federal Reserve dollars. And so you'd still have to do something about it. Would the free banking arrangement that you've introduced be of any use at all? Yes, it would. It would make our banks stronger. It would make them less reliant on the central bank, particularly as a source of circulating currency. It would begin to introduce something like the self-regulatory mechanisms that were part of past free banking systems. It would ultimately, though, make it easier to impose stricter rules for the issuance of Federal Reserve money. And indeed, I think if you had a real free banking system, you could eventually work your way towards an arrangement where you could very strictly regulate the supply of Federal Reserve dollars and even shut down the FOMC, leaving it at best to a computer, as Milton Friedman once suggested, to just spit out 3% more every year. That would work a lot better with free banking than it can now. Now, if you did something like that, a rush for currency would mean a rush for Federal Reserve dollars that could be extremely destabilizing, because there'd be no BB&T that could supply other currency in place of those dollars.
Thank you for your talk. There were a lot of relationships that I didn't really quite understand, but one that I found really interesting. You said that it was the amount of government debt that determined how much could be lent. Could you explain that?
Under the national banking laws started in the Civil War, national banks could issue currency, paper notes, but on their balance sheets, in their books, they couldn't use any old assets to back their notes. They had to have behind those notes U.S. government bonds. So say a bank had outstanding $100,000 of its notes. It would have had to have face value actually $110,000 worth of U.S. government bonds on hand. Otherwise, anything less, it could have more, but anything less, it would be violating the terms of its charter. So the total maximum allowable supply of national banknotes was, of course, restricted by the available stock of those eligible government bonds. When the government's retiring its bonds, it's making it harder and harder for banks to get hold of them. By the way, around 1890, practically every dollar's worth of those eligible bonds is held by national banks who've been forced to pay a premium to get their hands on as much as possible. But with the supply shrinking in total, of course, banks must manage with less, and that means the supply of currency has to be reduced, and that in turn translates into less lending.
So as I take it, this is no longer the case.
No, so when the Federal Reserve System was established, the original idea was that originally people were talking about having emergency supplemental currency, but very soon, in fact, in the Federal Reserve Act as it was finally written, it was anticipated that the Federal Reserve notes would completely take the place of national bank notes, which were accordingly phased out, with the last of them being issued in 1935. So they're all gone. They're collector's items.
Thank you.
Thanks. So it's a little bit hard to put in one question what I want to know, but I'm going to try. What is your perspective on the Austrian School of Economics position in which they say that banks have the obligation to 100% reserve of the deposits they receive from their clients, and that is the only way to prevent the boom and bust cycles and money rushing problems, etc. So
first, I'd like to mildly correct you in characterizing that view as the Austrian view. There are self-styled Austrian economists who reject that view and others who uphold it. So there's a division in that school amongst the proponents of that view and their opponents. I don't call myself an Austrian economist or any other sort of economist. I don't mind being called a monetary economist. But on that debate, I take the position of those who defend fractional reserves. And I've done so rather strenuously in the past. How can I summarize my view? Well, I'll summarize it by saying that I think, first of all, those who condemn fractional reserves show an inadequate understanding of both the theory and the experience of fractional reserve banking. They don't seem to be willing to recognize the many cases, Scotland's and Canada's are only two of many, in which we had successful, flourishing, stable, fractional reserve banking systems, sometimes with very low reserve ratios. Those systems worked very well. Now, of course, if fractional reserve banking didn't give you any advantage that 100% reserve banking couldn't also supply, we might say, well, let's not take a chance. But it provides very important advantages, and this is the other thing I fault the 100%ers for. And by the way, if you want to get this perspective right, you can do no better than to read Adam Smith's, the sections of Adam Smith's Wealth of Nations on money. Fractional reserve banking has played an extremely crucial role in the history of economic development worldwide. Every industrialized nation got that way thanks in no small part to fractional reserves. Even economies like the US, where the fractional reserve systems were not very well regulated or were over-regulated and badly regulated, even in those cases, fractional reserves contributed crucially to economic development because the kind of credit banks could supply was absolutely essential. Indeed, since those days, since the 19th century, we've had much greater development of bond markets, stock markets, all kinds of markets for savings and investment that don't involve banks. And yet, even today in the industrialized countries, if you got rid of bank lending, you'd know it. And but in the past, it was that much more crucial because other kinds of intermediation simply didn't exist on any great scale. There was no substitute for bank credit at all. So people, including not just the Austrians, but certain Chicago economists in the past and now more recently a revival of the same, seem to not know their banking history. They don't know what fractional reserve banks have contributed to economic prosperity. They don't know that there have been stable systems. They also don't know the history of 100% reserve banking. If they did, they'd know that it's mostly been a government intrusion in the marketplace. All of the past 100% reserve institutions were created by governments outlawing fractional reserves, usually with fiscal and other motives in mind. And there was a great deal of corruption involved. I've written about this on my blog at freebanking.org on one of my contributions to that. So finally, one more word. The Austrian 100% reserve camp, not the Chicago one, relies often on the claim that 100% that fractional reserve banking is fraudulent, that involves the multiplication of titles, etc. All I have to say about that is that, again, it shows ignorance of the history and the theory, in this case the legal history, the law, going back to ancient times, which considers coins that are handed over loose to a money changer or banker or whatever you call it, those become the banker's property. It has been so since ancient times. It was a well-understood principle. If you didn't want the banker to lend your money, you put it in a sack and sealed it. And then it didn't happen. But the Austrians go around telling you, oh, the banker's using, you know, it's your property. He shouldn't be lending it. He's cheating you. the most basic account of the legal principles of money changing and banking should have put paid to this kind of claim, and would have if only the people making it would take seriously the criticisms that have been made time and again of their assertions.
Thank
We
you.
need to cut it out. Okay, thank you. Sorry.